What's going on, Dividend Chasers? It's a Dividend Bloodhound here with another investing episode. In this episode, we're going to backtrack a little bit and go back to my Trading 212 portfolio review. I'm actually going to do some in-depth analysis show you the in-depth analysis of the stocks I bought that now reside in my portfolio. If that sounds like something you would like to partake in, then please stick around into the next part of the video. Just quickly, the four stocks I bought are Continental, BMW, Bayer and Allianz. These stocks are European companies. My Trading 212 is the riskier portfolio. It is not my ISA. The ISA resides with Freetrade, and that is where the majority of my savings go into UK and American stocks. If you enjoy this content, guys, please hit that like button in the corner there and subscribe to the channel if you're new here, and even hit that notification bell if you feel like getting notified of my content in the future. That being said, I'll catch you on the other side. What's going on again, guys? Thank you for joining me in the next part of this video. So as you can see, this is my portfolio, and you can see where the four stocks reside: Bayer, BMW, Allianz at the top there, and then Continental just down here at the bottom. And coincidentally, that is where we are going to start, with Continental. So Continental is a tyre company, is what you will know it for, but it is a whole lot more than that. I will go into that in a little bit in a while. So first up, ticker is CON. It has a market cap of just shy of £15 billion, revenue of 44.48 billion, EPS of €4.64, and a PE ratio of 15.91. Dividend yield is not listed here, but when I looked on Continental's corporate website, the yield comes out at 4.95%, and it has now gone ex-dividend. Has a net income of minus 1.23 billion at the moment, and the reason that is obviously the health crisis is taking a big stab at that, but also they've had to downgrade some of their intellectual assets that they own and patents that they owned for the future that have now devalued and have either become not useful, or other competitors are doing them and they've not made such revenue on them as they thought they would. But the usual side of things, their tyres are, that part of the business is absolutely sound, which is the mainstay of what they produce. However, they do produce a hell of a lot more, and I'll go into that in a second or so. So the dividend has been paid since 2011, and it has grown 200% since then. So there's been a huge increase over the last 9 years. However, what I will say is that it's just tapered off just recently because of the issues that they're suffering at the moment, and the last 3 years' growth has come down slightly to minus 2%, but I think that is mainly due to the devaluation, as I've already mentioned, and the share price coming down a significant amount as well. So it's currently trading at €76 a share, but in the last year, it's been, due to the health crisis, it's been down to 64, but it peaked this year at well over 140. But if you look over the very long term, it peaked in its lifetime at €250 a share. I'm not expecting it to get back to that, but I am expecting it to reappreciate up to this sort of level, up to €140 a share. So as I said, Continental is a company that produces a hell of a lot more than just tyres. There's a lot more technological things that they do in terms of safety and cars, and they've also developed a wireless charging pad that you can park your car over while you're at home and charge it just like you would a wireless phone. Now, I think that is absolutely fantastic technology, and I think that could catch on widely, not just in Germany but across the rest of Europe and the world. There's also talk of potentially outrolling that technology to like the inside lane on a motorway, where the majority of it will, the time cars spend their time to charge their cars as you go, and obviously they need to find a way to monetize that, but the potential is absolutely huge. I mean, having it in your home will just be the convenience side of things. They could sell it and they could fit it there, but getting it out on the road, they'll need to sell it to governments. But with the way the world's moving at the moment to greener energy, that is a absolutely excellent idea, and they've got so many patents I looked into. Guys, please do your own research, but this company has a lot of potential. That being said, that wraps us up for this one, so see you back in the real world. What's going on again, guys? Welcome back to the real world. So what do we think of Continental then? Absolutely brilliant company in my terms. Innovative and pedigree in its past. Not just a tyre company, got so many patents, so many new products coming. I'm really looking forward to seeing where this company will be in a few years' time. Recovering that share price in terms of appreciation and maintaining that dividend. That wraps us up for Continental. The next stock we're going to get into is Bayer, the huge German pharmaceutical company. I love pharmaceutical companies. The need will always be present. Not quite got the same pedigree as Johnson & Johnson, but that's not what this portfolio is about. But it does have a much higher yield, and it looks like it's a sustainable yield as well. But obviously Johnson & Johnson has got like 50 years plus, not taking anything away from Johnson & Johnson. But let's get in there and have a look at the analysis. Catch you in there. Hello again, guys, welcome back into the app. Our next stop is Bayer, or ticker BAYN, the huge German pharmaceutical company. Has a market cap of 56.93 billion, a PE ratio of 11.45, revenue of 43.55 billion, EPS of €5 per share, and a dividend yield of 4.83%, and a total net income of €4 billion. Not an insignificant feat at all. Currently trading at €59 a share, down from a peak this year of 78 due to you know what, and went all the way down to 47 and up to 77. So quite a nice little margin to make here on a dividend paying stock. It's paid its dividends since 2011, and its 3-year growth has been 1.76%, which has tailed off in the last 2 years due to a slight dip in revenue and this crisis so far. But it has been paying a healthy chunk going forward from 2011 until now. Company is into all sorts of different healthcare segments: pharmaceuticals, consumer health, crop science and animal health. And then if you break it down even further, there's all sorts of dermatological parts, dietary supplements, angalistic, gastrointestinal, cold, allergy, sinus, flu, foot care. The list just goes on and on and on. An enormous company, and a bit of a different one, which you could be a competitor to Johnson & Johnson in a different light, paying a slightly higher yield. Johnson & Johnson certainly has its place in my other Freetrade portfolio at some point soon, but this one over here, I just thought I'd like to keep it European. That being said, I'll catch you back outside. What's going on again, guys? Welcome back. So what do we think of Bayer then? Absolutely huge company, lots of potential further growth in its share price, really good sustainable revenue and net income. Going forward, I think this company will still continue to pay its dividend just nicely, which is exactly what I'm looking for, and then there'll be a margin of appreciation for me to make as well. Now then, that wraps them up. Next up, I'm going to go into BMW. Everybody knows who BMW is, and I want a slice of that sort of premium car club and the almost fanatical ownership that some people go through. They will drive a BMW for the whole of their lives and spend hundreds of thousands of pounds on it, or euros or dollars or whatever it is, over the course of their lives and never drive anything but. And I think that sort of branding has absolutely huge potential to just keep churning over money left, right and centre. I know some people will think that, oh, stay away from cars because there is there's a smaller profit margin to be made on cars. But the German heavyweights have been doing it for years and they've become very, very good at it. I'm looking forward to seeing what BMW and to an extent Mercedes, because I also own shares in Mercedes, what they're going to do to the electric car market to hit back at Tesla over in the United States. And I'm looking forward to the battle and the potential price war that will develop between these three companies, even to keep them competitive. And keep them producing the very best premium cars that are out there. That being said, let's get into the app and let's go and have a look at what's going on. Hello again, guys, welcome back in. Our next one is BMW. So here we go, a ticker of BMW, surprise, surprise. A market cap of 33.41 billion. P/E ratio of 6.85, revenue of 104 billion, EPS of €7.53, and a dividend yield of 4.83%, going ex-dividend very soon as well. It has a net income of 4.92 billion, absolutely excellent profit after all things said and done. Been paying a dividend since 2011. Its dividend growth has stagnated a little bit recently to minus 10%. However, I think that is due to the depreciation in the share price that we have seen until recently. So currently trading at €51.90, went all the way down to €39 at one stage, and then peaked in the last year at €75 a share. So again, there could be a margin in it again over the longer term when all this is said and done and we can actually get out and start driving and buying our cars again properly. A huge diverse range of models and options, moving towards an electrical car market now in the future. But they still own other brands such as Mini and Rolls-Royce. I didn't know that they owned Rolls-Royce up until recently. They've produced the electric Mini recently as well, so that's going down as a hit. There's also a motorcycling element, which is also extremely profitable. This company is an absolute animal of a cash machine. Really, really good. And hence why I've added it to my portfolio. And that wraps us up for BMW, so I'll catch you back out in the real world. BMW then, a company that you will all recognise, and hopefully you will agree that it's earned its spot in my portfolio for the future, both in terms of what I'm trying to do, which is gain some appreciation in the share price due to what is going on at the moment, and still gain a decent dividend in the process. That being said, I think we're all wrapped up on car companies for now, and we're going to check out now my last stock, which is Allianz. Allianz, the insurance and asset managing company that is well over €1 trillion worth of assets under its belt. Let's get in and let's have a look. Hello again, guys, welcome back. Yep, just going to jump into Allianz now. 0.27 shares for me at £40. So yeah, the ticker is ALV. We have a market cap of 67.90 billion, a PE ratio of 7.1, revenue of 103 billion, which is suspicious. It's very close to BMW's. Nothing in that at all, just like looking at the same, almost like deja vu, looking at the same thing twice. EPS of €22.94, a dividend yield of a big hefty 5.90%, and a net income of 7.91 billion, which is absolutely huge. And as you can see there, they got €1 trillion worth of assets under their belts. This company is absolutely enormous in terms of what it manages and what it provides. You name the insurance, they provide it. You name the investing portfolio or ETF or whatever you want, you can get hold of it through this company. And I'm not surprised that they manage some of the Germany's wealthiest people's portfolios. Been paying a healthy dividend since 2011, and its 3-year growth is 8.1%, which I think is pretty darn good if you ask me. Not a great deal to say about this company. Everybody will recognise it again, especially if you're European. I recognise it most from being the insurance, well, they are obviously an insurance provider, but they are the sponsors of where Saracens Rugby Club play their rugby, and the ground is called Allianz Park, so that's where I know it from very personally. I've been to the ground myself. That being said, I think we'll wrap it up here, and I love saying the word wrap it up as well, can't you tell? And I'll see you back in the real world. Catch you in a second. What's going on, guys? Welcome back. One thing I did forget to mention while we were in the app is the current share price was roughly €159. Has been down this year due to, yes, you guessed it, you know what, down to €119, and has been up at before the crisis began, at €230. So again, as you can see there is a significant margin to gain in the medium term there, I think, as we recover from the crisis. However, it has to be said, bear in mind that insurance companies are going to have to pay out left, right and centre there's a reason for the depreciation. They're going to have to cover people's problems left, right and centre because of having insurance policies in place. If you've enjoyed the video, please hit the like button in the corner there. If you're brand new, subscribe to the channel. That will help me out massively. Thank you for watching to the end of the video. Not many people do that, and if you have, brilliant, absolutely adore you. Let me know in the comments if you really want to, and I can thank you again personally, because I really need the watch time right now. And that being said, I think that rules out any further analysis for this month. Or for my trading 212 portfolio anyway, because I'm spent out. So next up is next month's review for trading 212, I think. Catch you on another day and in another video. See you later. Bye bye.